So Barry, I just want to pick it up on that point with respect to, inducing a recession. Have they gone too far? What does the US economy really look like right now when you look at housing, when you look at labor? You get so many different reads. Even the GDP print this morning was better than expected. What's the right read?
So I've been maintaining for over a year that the neutral funds rate, or rate that's that effective speed limit for the U.S. economy, was much higher than it was last business cycle. We got to 2.5% in late 2018. The economy appeared to stall. Now, I've argued that the reason the housing market stalled then was because of the change in the tax law as it pertained to the standard deduction and the SALT deduction, which is the high property taxes that existed in my old state, New Jersey and New York, so on and so forth. And also the trade war was causing downward pressure on growth. So I've maintained that the U.S. economy can withstand a higher funds rate, 4.5%, let's say. But the Fed's trying to do this too quickly, and they're causing financial instability, as we discussed a little bit earlier. So they do need to slow the pace. I think the path for inflation from 8 to 4 is very clear. And in fact, we may even overshoot that by my forecast by mid-year next year. But then inflation is going to stall out around that level. And the Fed may very well find themselves tightening again in the second half of next year, though clearly not as aggressively. Where we stand, though, with growth is when you look at consumer spending, which exceeded expectations a little bit today. We've been going through this giant rebalancing through the course of this year. We've had 3 quarters in a row where goods consumption was negative, but services consumption was stronger. That's the removal of COVID-related restrictions. Capital investment is a very interesting contrast from the last time we had inflationary recessions, 1970, 73, 75, 80, and 81, 82, because through the 60s, we had a real capital spending boom, and a capital spending boom in physical plant and equipment. That was increasing better than 10% per year. In the last decade, that increased 2% per year. So what we've seen in capital investment, we saw it this morning. We've seen it in bottoms up S&P capital investment. It's much stronger because of this secular trend and need to restructure supply chains. So that creates less vulnerability than we had even in those inflationary recessions. And one important thing for investors in particular for those inflationary recessions is that earnings don't fall nearly as much as they do when credit cracks, because those recessions were characterized by falling real growth but rising nominal growth. Earnings, even in the 2 deep ones, 73, 75, and 81, 82, only fell by 13% or so. So I would argue that earnings downside is much smaller than most of the street strategists and economists expect, because we're unlikely to have negative nominal growth. And furthermore, as I just explained, we don't have that downside risk to capital investment that could cause earnings to collapse as well, because we never had a boom, unlike the 60s.
Right. Right. What's interesting as well, though, when you say credit's not cracking or you don't expect it to crack, our viewers should understand as well. I mean, your background at Lehman and in derivatives. I want to get your take in terms of do you see any vulnerabilities there? It doesn't sound like it.
So I spent a fair bit of time on this on one of my recent trips to New York, thinking about all of the private equity related debt that was raised in 20 and 21, the big growth in the leveraged loan market, high yield market. That maturity wall for that doesn't begin until 2024. And then it gets really large in 2025. So there's going to be a lot of malinvestment, if you will, real estate deals that got funded at just ridiculous levels that will have to roll in 24 and 25. And they're going to prove to be really bad deals. But it doesn't look like it's a systemic risk like the housing market was for us in 06, 07, 08. It'll be a problem for anybody who invested in that stuff. And a lot of pension plans will probably have some serious struggles, but it just doesn't look systemic like when commercial real estate cracked in 1990, or the tech sector cracked in 2000, or resi real estate in 2008.
So it sounds as though maybe we've got a little bit of a setup for better markets ahead, Barry. Like maybe given the fact that we've seen so much damage that's already been done.